Welcome back to Talk Tickers. This is the deep dive where we strip away the fluff, ignore the corporate PR spin, and get right down to the raw signal for the professional investor.
Yep. We take that stack of earnings transcripts, the research notes, all the market data, and we try to turn it into something you can actually use. Actionable intelligence.
It's all about high-velocity summarization.
Exactly. We're looking for the disconnects, the anomalies, really the opportunities that the headlines just completely miss. Our job is to bridge that gap between what the C-suite is saying on the call and what the market actually seems to believe.
And today, today we have a doozy. It is Tuesday, February 17th, 2026, and we are digging into the Q4 and full year 2025 results for AppLovin, ticker symbol APP. And I gotta tell you, I've seen a lot of earnings reports in my time, but this one...
It's something else.
This one is a paradox wrapped in an enigma. I mean, it is the kind of print that makes you question if the market is broken or if the company is lying, or maybe we're just living in a simulation.
It really is a study in contrasts. If you were just looking at the spreadsheet, just the P&L in a vacuum, you would think this stock would be, I don't know, on its way to the moon.
Oh, absolutely.
You'd think the ticker tape parade was already starting on Wall Street and confetti was raining down on Palo Alto.
Right. I mean, let's just frame the setup here. We have a company that just delivered what I would call a perfect print.
That's the word for it, perfect.
Operational perfection. Revenue it's hyper accelerated. Margins are, frankly, they're kind of obscene. We'll get to the specific numbers in a minute, but they are effectively unheard of in the software space.
Yes.
And yet
the market hated it.
The stock was just hammered in after-hours trading immediately following the call on February 11th, down nearly 9%.
And it didn't stop there.
No. Then the next day, the sell-off just kept going. We saw it drop from around, 456 down to the 366 range.
That is a massive haircut. I mean, that's almost 100 points per share for a company that just beat expectations across the board.
It's the classic battle, isn't it? It's backward-looking financials versus forward-looking fear.
That's the core conflict we have to analyze today. It's operational perfection on one side versus existential AI anxiety on the other.
That is the theme. The numbers versus the narrative. The market is looking at this literal mountain of cash flow that AppLovin is generating right now. And instead of celebrating, they're staring into this black box of fear.
Total fear.
Specifically fear about Meta, fear about generative AI, and this, this pervasive fear that the party just has to end sometime. It's like winning the lottery and being terrified the check is going to bounce.
And management's stance on the call was, it was crystal clear. Adam Foroughi, the CEO, he basically came out and said, you guys are wrong.
He did. He was not shy about it.
No, he called it a massive disconnect between market sentiment and business reality. So our mission today is to unpack that disconnect. Who's right? Is this the ultimate value trap, or is the market just completely mispricing one of the most powerful growth engines in tech right now?
Okay, let's get into it. Let's start with the beat. Because even calling it a beat doesn't really do it justice. We are talking Q4 2025. What did the headline numbers look like?
They were staggering. Revenue for the quarter came in at $1.66 billion.
Sure.
That is up 66% year over year.
Okay.
Just pause on that for a second. We're talking about a company at this scale growing the top line at 66%.
You're right.
That beat the consensus, which is kind of hovering around 1.6 billion. Usually as companies get this big, the law of large numbers kicks in, growth slows down, AppLovin is somehow accelerating.
And usually when you see that kind of explosive growth, especially in tech, you expect to see some serious cash burn, right?
Of course.
You expect them to be spending heavily on sales and marketing to acquire that growth, the whole growth at all costs mindset.
That is the standard software playbook. But AppLovin has apparently just thrown that playbook out the window. Adjusted EBITDA was $1.4 billion.
Wait, hold on. Say that again. 1.66 billion in revenue and 1.4 billion in EBITDA.
Yes, that's an 84% margin.
That sounds illegal. How is that even possible? 84% margins. I mean, good software margins are usually 70, maybe 80% gross, but EBITDA, that's after operating expenses.
It just speaks to the extreme operating leverage of their model. Their CFO, Matt Stumpf, he highlighted this flow through. He noted that 95% of every incremental dollar of revenue flowed directly to the bottom line.
95%.
It's purely algorithmic scaling. They don't need to hire an army of salespeople to get that next dollar. The software does it. The servers do the work, not the humans.
So you've got this massive growth and this massive profitability all happening at the same time. I remember seeing a quote from the CFO about the rule of 40.
Oh, this is a great moment on the call.
Yeah.
For those listeners who might need a quick refresher, the rule of 40 is a standard metric for SaaS and software companies.
Yeah.
You just add your revenue growth percentage to your profit margin. And if it's over 40, you're considered, best in class.
Yeah, 20% growth plus 20% margin equals 40, gold star. You get a pat on the back from the venture capitalists.
Exactly. Well, Stuff pointed out that AppLovin is operating at a rule of 150.
150.
Yeah. You have 66% growth plus 84% margin.
Yeah.
It's completely off the charts. It basically breaks the heuristic that we all use to evaluate these tech stocks.
It breaks the chart. And the cash flow backs it up, right? This isn't just some accounting trick or, capitalized expenses.
No, it is real hard cash. Free cash flow was $1.31 billion in the quarter alone.
Wow.
And for the full year of 2025, they generated nearly $4 billion in free cash. To put that in perspective, that is more free cash flow than many companies in the S&P 500 generate in like a decade.
Okay. So it's a cash printing machine. But usually when a stock dumps after earnings, it's because the guidance was soft. Maybe the future looks bleak. Did they, sandbag the outlook?
And that's the thing. The guidance was strong. They guided for Q1 revenue between $1.745 billion and $1.775 billion.
And for context, Q1 is usually the hangover quarter for ad tech, right?
Absolutely.
Everyone spends their budget in Q4 for the holidays, Black Friday, Christmas, and then January is just dead. Ad rates plummet.
Precisely. Q1 is historically a seasonally soft quarter, but this guidance implies 5 to 7% sequential growth from Q4 to Q1.
Whoa.
They're growing quarter over quarter in the weakest season of the year. And they're projecting to maintain that, roughly 84% EBITDA margin.
So let's just recap this madness. Massive beat on revenue, massive beat on earnings, insane chart-breaking margins, guidance that completely defies seasonality, and the stock drops 9% after hours and just keeps on falling the next day. This is where it gets really interesting. The market is fading the beat. Why?
This is where we have to move into the narrative layer. The numbers are perfect, so the problem has to be the story. The deep dive here is really about the elephant in the room.
Let's hear it.
It's AI and competition. The market is terrified that this is peak earnings. They look at 84% margins and say, it literally cannot get better than this.
Right, the only way is down.
And then they look at generative AI and say, this is going to kill the business.
Okay, let's dig into that kill the business thesis, because to understand the opportunity, we have to understand the fear. What is the bear case specifically?
The bear thesis is centered on the disruption of the entire app ecosystem by large language models. LLMs. The logic goes something like this. AI makes coding trivial.
Okay.
If AI can write code, then making a mobile game becomes incredibly easy. The barrier to entry for creating a game just drops to zero.
Okay, so we get a flood of new games.
Right. The fear is that the market will be flooded with low-quality content, or, conversely, that AI will allow developers to just bypass ad networks entirely. But there's a darker fear underneath that, displacement.
Meaning?
The fear that people will just stop playing games and talk to chatbots all day, or maybe that an AI agent will play the game for you.
So the fear is a total structural collapse of the mobile economy as we know it. Now, Adam Foroughi, the CEO, he didn't dodge this, did he? He addressed the short sellers and all that anxiety right in his opening remarks.
He did. He was quite defiant, actually. He laid out what I would call the abundance argument. And this is a really fascinating economic counter-thesis.
Okay, walk us through that, the abundance argument.
So management agrees that AI lowers the cost of creation. They agree that content creation will explode. But they argue that this is a tailwind, not a headwind.
How does more competition among game makers help AppLovin? I mean, if I'm a game studio and suddenly there are a million new competitors, I'm hurting.
You're hurting, yes. But you have to remember, AppLovin isn't a game studio anymore.
They're the toll booth.
They're the toll booth. Think about it.
Yeah.
If content becomes infinite, if there are millions of new games being created because the coding part is free, then the content itself becomes commoditized. It loses its scarcity value. When content is infinite, what becomes the scarce resource?
Discovery. Finding the needle in the haystack.
Exactly. Discovery becomes the bottleneck. And AppLovin owns the discovery engine. They own the auction. So if you have 10 million game developers all fighting for your attention, they all have to come to the auction house to buy users. That drives up bid density.
I see. So instead of a few big studios dominating, you get this massive long tail of creators who all need to pay the gatekeepers to get an audience. It's just simple supply and demand. Supply of games goes way up. Demand for users stays constant, so the price of access goes up.
That is the argument. Adam said it explicitly. When content becomes abundant, discovery becomes a scarce resource. He believes their AI model, Axon 2.0, is the best in the world at matching users to that content.
Right.
So the more chaos there is in the content layer, the more valuable the ordering mechanism, which is AppLovin, becomes. It creates a chaotic sea, and AppLovin is selling the only compass.
That makes a lot of sense. It's the classic picks and shovels argument for the AI age. But there is another specific fear that investors have, and it has a name. Meta. Facebook. The 800-pound gorilla.
The meta fear is pervasive. It really is. The anxiety is that Meta is going to enter the mobile gaming ad auction more aggressively. Investors see Meta's Advantage Plus campaigns and their massive budget, and they just assume Meta will come in and crush AppLovin.
Right, and if Meta starts bidding on the same inventory as AppLovin, doesn't that hurt AppLovin? I mean, if Zuck wants the user, Zuck usually gets the user.
This is where we have to really understand the mechanics of the auction. It's not a fist fight, it's a math problem. Management argues that investors are falling for what they call the zero-sum fallacy.
Meaning they think if Meta wins, AppLovin loses.
Exactly. They think that if Meta wins an impression, AppLovin automatically loses.
Okay, so explain why that's wrong.
So AppLovin runs the mediation stack. It's called MadeX. This is the software that publishers use to manage their ad inventory. When an ad slot opens up on your phone, an auction happens in milliseconds. Multiple bidders submit prices. AppLovin bids, Meta bids, Google bids, and so on. Management's point is that as bid density increases, as more big players like Meta enter that auction, the overall size of the pie expands. The publisher makes more money because competition drives up prices.
Okay, that helps the publisher. I get that. But how does it help AppLovin if Meta wins the bid?
Two ways. First, there's what you could call the tax.
That's a tax.
Yeah. Even when AppLovin loses an auction in their own mediation stack, if the winner is a third party like Meta, AppLovin still charges a 5% fee on that winning bid.
Ah, so they get a cut of the action regardless. They are the casino. The house always takes a rake.
Exactly. But there's a second, much more nuanced point that Adam made. He called it the bad impression theory.
The bad impression theory. That sounds counterintuitive.
It does. But he argued that AppLovin's data on gaming users is so granular, so specific, that they know exactly which impressions are valuable to them. So if their model bids low on an impression, it's because they don't think that user's going to convert.
So if Meta comes in and bids high on that same impression...
Adam is essentially saying, let them have it. If a competitor wins an impression, it is likely an impression that AppLovin's own model valued poorly. They are happy to let Meta pay top dollar for a user that AppLovin's algorithm has already deemed low probability.
Right.
Meanwhile, AppLovin saves its cash to bid on the high probability users that it really wants.
That is some serious confidence in their algorithm. He's basically saying, we know the user better than Zuck does. Yeah. And that's a bold claim. Meta knows everything about everyone.
In the general sense, yes. But in the context of gaming, AppLovin might actually have the edge. And he laid out the technical defense for that.
Which is what?
Meta targets based on a social graph, who your friends are, what you like, what groups you're in. AppLovin targets based on a transactional gaming history, what you play, what you pay for in games, how often you engage, specifically within the app ecosystem.
And this all comes back to IDFA. Since Apple changed the privacy rules, that social graph data is a lot harder to use for app installs, isn't it?
Precisely. Let's use an analogy. Before IDFA, Meta basically had a GPS tracker on everyone. They knew exactly where you went online and what you bought. When Apple introduced app tracking transparency, they essentially just smashed the GPS.
Right.
Now, Meta is looking at a blurry photo trying to guess where you are.
And AppLovin?
AppLovin runs the mediation layer. They are inside the building because they see the transactions happening inside the mediation stack across thousands of apps. They have a closed loop of data. They don't need the GPS. They're the floor manager watching you walk into the store. They argue that social networks can't easily replicate that data fidelity without violating Apple's terms, specifically around fingerprinting.
So the bull case on competition is, we own this casino, we own the data, and if the room gets more crowded, we just collect more rent.
That is the argument. And frankly, the financial results, they support it. You don't hit 84% margins if you're losing pricing power or if your targeting is broken.
True. That's a very good point. But let's pivot to the growth engines. Because for this stock to work long term, to justify the kind of trade we might talk about later, it can't just be about squeezing more money out of Candy Crush.
No, they need new frontiers.
They do.
And they broke it down into two main buckets: the core gaming business and the expansion, which they are now calling web advertising or e-commerce.
Let's touch on gaming first. Is it tapped out? I mean, every time I get on the subway, it feels like fewer people are playing games and more people are scrolling TikTok.
According to them, absolutely not. They describe the performance as the strongest in company history.
Wow.
Internal dashboards are showing no slowdown. And the CEO really pushed back hard on that demographic fear.
The fear that we'll all just stop playing games.
Right. He noted that the casual gamer demographic actually skews older and female. They're playing what he called relaxing games: solitaire, mahjong, match-3 puzzles.
My mom loves those games, and she is definitely not going to stop playing Mahjong to go code Python with the chatbot.
Exactly. That's his point. This habit is sticky. It serves a very real human need for relaxation and distraction. It is very unlikely to be replaced by LLMs. In fact, if AI makes people more productive at their jobs, they might have more time to play games.
Good point.
It's a leisure activity, not a productivity task.
Okay, so gaming is the cash cow. It funds the whole operation. But the exciting part, the part that could turn this into a mega cap company, is the e-commerce expansion.
They're pivoting the language a bit here, aren't they?
Yes, they are. They're moving away from just saying e-commerce and broadening it to web advertising. Basically, any transactional site on the entire internet. They want to power the ads for everything you buy, not just everything you play.
And how's it going? Because this is the black box part for investors. We can't see the algorithm. We just have to trust them on this.
We can't see the code, no, but they did give us some incredible performance metrics. The one that really jumped out at me was the LTV to CAC break-even.
Okay, translate that for us. Use small words for the back of the class. LTV is lifetime value. So, how much a customer is worth to you over time? SAC is customer acquisition cost, how much you paid to get them in the first place. They stated they are seeing a 30-day break-even.
Whoa. So if I'm an advertiser and I spend $1,000 on AppLovin ads to get new customers,
You are making that $1,000 back in profit from those customers within 1 month.
and you keep the customer relationship for years after that.
You do?
That is insane. I mean, in the world of advertising, a 6-month or even a 12-month payback is usually considered good.
It is.
If I have to wait a year to get my money back, that ties up my cash flow. 30 days, that's basically free money.
It suggests the algorithm is incredibly efficient at finding high-intent buyers. It reduces the working capital cycle for the advertiser dramatically. And to illustrate this, management told a very specific anecdote about an Israeli cookware company.
I loved this detail. It's so random but so specific. Why cookware?
It serves as a perfect test case, right? It's as far from gaming as you can get. They cited a cookware company that went from $4 million in revenue to $16 million in revenue in just 1 year.
Okay.
And how do they do it? By spending 65% of their entire budget on AppLovin.
So they basically bet the farm on the AppLovin algorithm. They just pushed all their chips in.
And it paid off. They are now projecting $80 million in revenue for the next year.
That is a 20x growth trajectory in 2 years, driven primarily by this one ad platform.
And the significance here is that it serves as a proof of concept. Investors have been worried that AppLovin's algorithm only works for games. Oh, you can find a gamer, but can it find a person who wants to buy a frying pan?
Right, because finding a gamer involves different data signals than finding a home chef.
Exactly. This anecdote is their answer. Yes, it works for frying pans too.
And if it works for frying pans, it works for shoes, for insurance, for travel, for anything.
Theoretically, yes. And that expands their total addressable market from just the gaming ecosystem, which is about $100 billion, to the entire internet economy, which is in the trillions.
Now, there's a bottleneck here, right? If I'm a cookware company, I don't necessarily have a team of video editors to make high-quality mobile ads.
That's the friction point.
Mobile ads need to be flashy, fast, interactive.
That is the bottleneck for new advertisers. In gaming, the big studios have armies of artists. A cookware company might just have product photos.
So how are they solving that?
Generative AI. This is where AI becomes a massive accelerator for them, not a threat. AppLovin is piloting Gen AI tools that automatically build the interactive end cards and the video creatives.
So I just give them my product images and the AI spits out a video ad?
Essentially, yes.
Yes.
The goal is to reduce the creative costs from thousands of dollars per ad down to pennies. And this allows for massive A/B testing. Instead of testing 2 versions of an ad, you can now test 2,000 versions.
And since they own the feedback loop, the algorithm can instantly see which one of those 2,000 versions is working and just double down on it. It's evolution on steroids.
Correct. It democratizes access to their platform. It removes the barrier to entry for the non-gaming advertiser. It solves the cold start problem for creatives.
So we have the core business cranking. We have the new business showing 30-day paybacks. We have AI solving the onboarding friction. Let's talk about the war chest, the financial fortress. Because in a volatile market like this, cash is king.
It is a fortress indeed. We mentioned the $1.31 billion in free cash flow in the quarter.
Yeah.
But look at the balance sheet. They are holding $2.5 billion in cash.
And they're not just sitting on it. They are buying back stock aggressively.
Very aggressively. They repurchased or withheld $482 million in stock just in Q4. For the full fiscal year 2025, they bought back $2.58 billion worth of shares.
And they still have authorization for more.
They have $3.3 billion remaining on their authorization.
That is huge. I mean, think about the signal that sends. The market is selling the stock, pushing the price down, and the management team is sitting there saying, thank you very much, we will take those shares off your hands.
It is the ultimate vote of confidence. Management views their own stock as the best investment available to them. They see the valuation disconnect, they know the internal numbers, and they're using that massive cash flow to reduce the share count.
Which is accretive.
Very. Over the last year, they reduced the share count from 346 million down to 340 million.
That makes every remaining share more valuable. It's like slicing a pizza into fewer slices. Each slice just gets bigger.
Exactly. And it also acts as a kind of floor on the stock price. It's hard for a stock to go to zero when the company is actively buying back billions of dollars worth of it every single year.
Yeah.
It creates a soft floor under the price action.
One question on the margins, though. 84% EBITDA. Can they really hold that? The CFO seemed to imply they might spend more on marketing.
He did. He implied that they are happy to hold 84%, unless they see a massive opportunity to spend on marketing, specifically on branding for Axon to acquire more advertisers.
But if they spend more, margins go down. And investors hate falling margins. They panic when they see the graph dip.
Usually, yes. But you have to remember that LTV-CAC ratio we just discussed.
The 30-day payback.
Right. If they spend $1 on marketing and get that dollar back in profit in 30 days, plus a stream of future cash flows, margin compression due to that kind of spending is incredibly accretive long-term.
Right. It's good margin compression. It's investing in growth, not just bloating overhead. It's like buying a money printing machine for $1 that prints $10.
Exactly. But for now, they are guiding to maintain that 84% line, which suggests they're being very disciplined. They aren't just lighting money on fire for the sake of awareness. They're mathematically driven.
Okay, so we've painted a pretty rosy picture here, but we have to respect the price action. Stock dropped. The market is smart. So what are we missing? Let's do the investor context. The cage match. Bear versus bull. Why is the market so scared?
The bear case is powerful because it's rooted in fear of the unknown. It's not about the numbers today. Everyone agrees the numbers today are great. It's about the black swan.
Fear of regulation.
Regulation is part of it. The DOJ, the SEC, ad tech is always under scrutiny. But the bigger fear is peak earnings. When you see 84% margins, your instinct as an investor, your pattern recognition is to say, this is a cyclical peak. It can only go down from here. It feels like buying a semiconductor stock at the top of the cycle.
Right. Trees don't grow to the sky.
And then there is the black box problem. Investors really struggle to model this business. You can't just put price times quantity into a spreadsheet. You have to blindly trust that Axon 2.0 will keep working. You can't audit the algorithm.
It requires a leap of faith.
It does. And Wall Street hates leaps of faith. They prefer calculated risks. If the algorithm breaks tomorrow, or if consumers change their behavior, or if Apple changes a setting again, the revenue could, in theory, just evaporate.
And with the AI narrative shifting so fast, investors are just hesitant to take those leaps of faith on what they see as legacy ad tech.
Exactly. They are terrified that a chatbot will replace the App Store next Tuesday. They view AppLovin as the old world and AI as the new world.
That's the bear case. Fear, uncertainty, and the feeling that it's all too good to be true. Now, what's the bull case?
The bull case is that this is a software margin business that is trading at a massive discount because of those misunderstood risks. The bull says the moat is data, not just code.
The closed loop.
Yes. The bull argument is that the closed loop of data, seeing the bid, the impression, the click, and the final transaction, is getting smarter faster than anyone else can catch up.
Right.
And e-commerce is a free call option. Even if gaming stays flat, if e-commerce works, this could be a 10-bagger from here.
So the bull sees a fundamental mispricing of risk. They see a company printing cash, buying back stock, pivoting successfully, while the market treats it like a melting ice cube.
It is one of the starkest divergences I've seen in a long time. The fundamentals are screaming buy, and the narrative is screaming run, and that divergence, that's what creates opportunity.
Which brings us to the part of the show where we put our money where our mouth is, or at least where we pretend to.
Indeed. The theoretical trading desk is officially open.
Okay, standard disclaimer. This is not financial advice. We are not financial advisors. We are just two voices in your headphones analyzing the madness of crowds. Do your own diligence. Don't sue us if you lose your shirt.
Please don't.
But if we were running a hedge fund pod and we had to pitch an idea to the investment committee based on this print, what is the trade?
We call this trade the cognitive dissonance spread.
I love the name. It sounds both academic and dangerous. Break it down for us.
The concept is to capitalize on the fact that the market is pricing in terminal risk, the death of the company, while the company itself is printing record cash. We want to use the market's fear to fund our upside.
Okay, so how do we structure it?
It's what you could call a paid-for upside call spread. Or, more specifically, it's a risk reversal structure.
Okay, leg one.
Leg one is the short. You sell short-dated, deep out-of-the-money puts.
Okay, selling puts. For the listeners who don't trade options, selling a put means you are taking on the obligation to buy the stock if it drops to a certain price. That's usually a bullish stance. Why do we like this here?
Because of the CFO. Management has $3.3 billion in buyback firepower. They have explicitly stated they view the stock as undervalued. They are the floor. If the stock drops another 10 or 15%, you know that buyback machine is going to turn on.
So you are essentially co-investing with the CFO's buyback desk.
Yeah.
If the stock drops, you get assigned the stock, but you're buying it right alongside the company itself.
No.
You're catching a falling knife, but you're wearing a Kevlar glove provided by the company's balance sheet.
Exactly. You are selling insurance to the bears who are terrified of a crash. And because the implied volatility is so high right now, the premiums on those puts are very rich. The fear makes the options expensive.
Okay, so we sell the puts and we collect that juicy premium. Cash hits our account. What do we do with that cash? Leg two.
We use that premium to buy LEPSS, long-term equity anticipation securities, specifically call options for 2027.
So we are using the bears on money to bet on the bull case.
Precisely. We are financing our long-term bet using the market's short-term fear. If the AI death narrative doesn't materialize in the next 12 months, if AppLovin just keeps printing $1.5 billion a quarter,
Right.
the multiple compression will have to unwind.
Right.
Stock doesn't even need to grow earnings massive amounts from here.
Yeah.
It just needs the sentiment to revert to normal.
If the PE ratio goes from distress back to just average, the stock doubles.
And with EPS, you get leverage on that move. If the stock doubles, the EPS could 5x or 10x.
That is outrageous. I love it. We're betting that Adam Foroughi is right, and the entire collective consciousness of Wall Street is completely wrong about how AI impacts ad tech. We're betting on the algorithm over the narrative.
It's a high-conviction bet on data over fear, and it aligns your timeline with the company's actual execution rather than the market's weekly mood swings.
Well, there you have it. The cognitive dissonance spread.
High risk, high reward. Only for the brave.
All right, let's bring it home. Recap time.
AppLovin crushed the numbers. $1.66 billion in revenue, 84% margins. Operationally, the business has never been better.
But the market crushed the stock, down nearly 9% on AI and competition fuels. The meta boogeyman is looming large.
And management is defiant. They're claiming best performance in history and a massive disconnect. And they are backing that up with billions and billions in buybacks.
So the final thought for the listener, something to chew on during your commute home.
It really comes down to a philosophical question about the future of software. Do you believe AI replaces apps, or do you believe AI multiplies them?
If AI replaces apps and we all just stare at a single chat interface, one ring to rule them all, then yeah, AppLovin is a value trap.
If AI multiplies apps, if it lowers the barrier to creation so that we have millions of new experiences and a chaotic, infinite sea of content, then the company that organizes that chaos,
Yeah.
the company that provides the map,
Yeah.
it becomes the most valuable player in the entire ecosystem.
Discovery is the scarce resource in a world of abundance. That is the bet.
That is the deep dive.
Thanks for listening to Talk Tickers. If you enjoyed this, do us a favor and rate and review us. It helps the algorithm find us.
The irony is noted.
We'll see you on the next print.